Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield, and we've got a special guest this week. We're joined by Chris Tilley from Coutts Private Markets Team because we're going to be looking at Rachel Reeves' maiden Mansion House speech and some of the proposed changes. But first of all, let's welcome everyone. Hi, David. How are you?
Hi, Sarah. I'm good, thanks. I'm scooching up on the virtual couch, making room for Chris.
Exactly. Welcome, Chris, to Need to Know, making your debut.
Thank you, Sarah. Thank you for having me. It's great to join you and David.
Brilliant. Okay, now, Chris, the rule is quick fire numbers round. Have you got, I'll let you go first as you're our guest. Have you got a quick fire numbers round for us? Or a quick fire number, I should say.
So my number is 19 million.
Oh, okay. What's that?
So 19 million is the estimated number of people in the UK by 2050 will be over 65 years old.
Wow. Okay. That's a high number.
It's a good number. I think I used the same number for China a number of months ago, and obviously the number is astronomically large. Like all things in China.
Yeah, exactly. What's your number, David?
My number's a nice round number. It's very unusual for me, isn't it? 2000. Okay. And it relates back to our discussion last week about crypto. So 2000 was the number of Bitcoins that was moved for the first time since 2010 from what many people sort of colloquially refer to as Satoshi era wallets. Okay, so if you think about Bitcoin, there were a huge number of Bitcoins that were mined right back at the beginning from sort of 2009 to 2011. I think it's about 1.75 million Bitcoins were mined in that era. Okay. And basically that's about what, 8.3% of the total supply of Bitcoins, and very few of them are unspent. In fact, they're hardly ever touched. And somebody sort of just came out of the ether and moved 2,000 of them for the first time since 2010. Now, I had to quickly do the maths before the podcast. Do you want to guess? Well, you can work it out quite quickly, I reckon. But do you know what that translates to in sterling?
Oh, no, go on. My brain's not working.
Well, it's a mere, 142 million sterling.
At the time of recording, of course,
it will be probably 200 million, or who knows? We're all going to Mars with Elon after all.
Exactly. My number, as I always do, I like to be a little bit on the nose. So I've picked a number that relates to one of the topics we're going to be covering this week. Well, I've got two numbers actually, but I'm going to give my very simple number, which is 5. Now, 5 shillings a week is what you would have been paid the first government old age pension scheme that was introduced in 1908. And it was only paid to men over 70. Now, given that the average life expectancy of a man in 1908 was about 47, I don't think they had to pay too many old age pensions. But there you go, 5 shillings a week, which I don't know what's that equivalent to now. What, about £20 a week or something? 15, £20 a week? Not very much.
Wow. And of course, your stats entirely correct. When the system was set up, you're quite right. The average age was a lot younger than it is today. And reaching your pensionable age was a huge achievement.
Yeah, exactly. All right, then. So we are going to talk about Rachel Reeves' Mansion House speech, her maiden speech. I suppose I know we're going to break it down into 3 topics, but before we get to that, I guess the first question is, why are we even talking about the Mansion House speech? What relevance does it have to markets?
Well, I think that's the right question, isn't it? Because this speech happens in the City of London. It's a black tie event. It's the great and good of the city and policy-making circles that attend. And quite often, I think a lot of people read it and just think, well, okay, that's interesting, but so what? Why is this relevant? But those of our listeners who have been around for a while will remember this was the venue where some significant reforms, some significant legislation were announced. It's a direction of travel for policy. And okay, so what? 1984 was the big one. That was the Lawson speech on Big Bang reforms and deregulation. That revolutionized the whole UK's financial services sector for the next couple of decades. And then in 2009, you had Alistair Darling's famous speech about the global financial crisis and introducing all those measures that he had to do to stabilize the banking system. And then obviously a couple of years ago, Rishi Sunak announced UK's ambitions to leading green finance and aligning, the whole economy with the net zero agenda. So it's quite an important event, and unsurprisingly, Rachel Reeves has used that as her inaugural speech to present some bold reforms aimed at addressing some long-standing challenges in the UK economy. So, there's a lot that she has tackled head on, actually, dealing with the growth and effects of Brexit, some reforms to pensions, and we'll rattle through the list and try and get under the bonnet of a few of them.
Yeah. Okay. Well, let's start then with key takeaways then from the speech before we look at some of those in a little bit more detail, and particularly with the focus on private markets.
Yeah, of course. So we'll get into the conversation with Chris as well about private markets. That's definitely one that's sort of a lot of interest to people, I think. But when I went through the speech, and I've read a huge amount of commentary on it over the weekend, it really splits down into sort of three sections. You've got pension fund consolidation. So that was the announcement of plans to merge 86 local government pension schemes into these mega funds. Okay, so you're talking about managing 500 billion of assets, and then through that management, unlocking about 80 billion for investment specifically in UK infrastructure and businesses by 2030. Okay, and we can talk a bit about how that's been achieved elsewhere in the world, because that's not a new idea per se. It's new in this country, but other countries have already tried it with quite a lot of success, actually. The second big agenda item was the British Growth Partnership. So that's a new fund being managed by British Patient Capital, and that's channeling pension fund investments into high growth UK businesses. And I'm sure Chris will want to talk a lot about that. Then you have regulatory reforms. It wouldn't be a Mansion House speech without a healthy dose of regulatory reforms. But the idea here, in a nutshell, is to try and reduce financial sector red tape and encourage the prioritization of economic growth alongside financial stability. And this is, I think, the area that's attracted a lot of commentators' attention, because obviously there were lots of regulation and oversight enacted after the financial crisis for good reason. And I think any attempt to kind of unpick that just for the aim of economic growth will come with a lot of scrutiny, I think, and interrogation.
Yeah, because Rachel Reeves' comment was that we've been regulating for risk rather than growth, and so she obviously wants to switch that focus round, doesn't she?
Yeah, exactly. So I think it's about the detail now, obviously, and regulation for those that don't work in financial services. These documents, these handbooks and directives are very complex, and very far-reaching. And to make meaningful regulatory reform takes time and lots of lawyers' hours as well. So that's point 3. Point 4 that she brought up was dealing with the elephant in the room, really, Brexit. And irrespective of your view on the issue, Brexit is obviously having an impact on the UK economy. So if I was to summarize her program or her announcement, it's basically a renewed effort to try and strengthen ties with Europe to mitigate or manage this economic impact of Brexit. What that means, we can get into if we're interested. And then the final point was one that I think, putting my economist hat on, I find really interesting. This is about concerns about the labour market data that basically the Bank of England has to deal with. Okay, it sounds very technical, but obviously monetary policy is this very lumpy, very, I wouldn't say blunt tool. I know I've been very critical of central bankers in the past and their effectiveness at fine-tuning the economy, but Andrew Bailey has a point that we need to improve labour market data and the collection of labour market data to help better inform monetary policy decisions. So there's a bit of that as well. But I think our interest today is probably in the first two, would you say?
Yeah, definitely. So these mega funds and this British Growth Partnership. Okay, so what's the rationale then behind? Let's turn to the pension pot. So I looked at a few stats, and I believe that Britain's pension pot is worth around 3 trillion, which makes it one of the world's largest, but it's also one of the world's most fragmented. And I suppose the rationale is, my understanding is, you have fewer, bigger funds because it reduces costs and presumably they can have a greater impact when they invest. And is it fair to say they can take a bit more risk as well because they're bigger?
Yes, I suppose. Answering your question in reverse is that your liquidity. Well, look, you've got different challenges, but yes, you can start allocating a smaller pot of capital towards more illiquid, slightly more lumpy investments, and that's specifically private markets investments. But let's think about the landscape for a second, because you're right, we do have an incredibly fragmented system. We've got about 86 different local government pension schemes, and the idea is you merge those into larger mega funds, and you can look at the international precedent for that. Okay, I think I mentioned in my little intro that there's plenty of countries that have already done that to some success. So Canada has got about 370 billion sterling pot, having gone through that consolidation exercise, and they direct that pot at least partly into things like infrastructure, real estate, renewable energy, things that are traditionally privately listed, not publicly listed investments. Australia as well. I think in 2006, they did this massive merger into this sort of Australian super fund that then, again, similarly to the Canadian example, can start making significant allocations towards private equity and infrastructure. Denmark's done the same thing as well. The Scandinavians sort of led the way in that respect. So it's interesting. You've got a number of trends, I think, happening at the same time. You've got consolidation, which drives costs, efficiencies, and allows you as a pension fund manager to manage your liquidity easier, potentially. I mean, liquidity is a double sort of edged sword. You know, having more money to invest is seemingly a good thing, but in the public markets, as anyone that's looked at top 10 holders on Bloomberg will see, all the sovereign wealth funds own everything in the world, because if you have too much money, ultimately you have to spread your risk across nearly the entire public market to prevent yourself as actually owning companies. Nonetheless, I think the international examples show that it can be very, very effective. It can be transformative. It's not without challenges, though. Managing the transition into that consolidated fund needs careful coordination, and then managing transparency, accountability, all those things that we talked about when we talked about sovereign wealth funds kind of apply here as well. And balancing returns for members against objectives, overarching sort of government objectives for economic growth, need careful balancing as well, because ultimately it's a members fund.
Yeah, absolutely. I want to come to you in just a moment, Chris, because when I was looking up the stats, currently UK pension funds allocate around about 4.4% to UK equities and around 6% to private equity and infrastructure assets. So I think it'd be good to understand, for those perhaps that are unfamiliar with the concept of private markets and what we're actually talking about here. Chris, could you start by giving us a little bit of context on what are private markets? What's the size of private markets? What are we talking about here?
Yeah, super. Thank you, Sarah. And I think it's really important. I think when we talk about private markets, because there's lots of sort of interchangeable terms that people use, you think about private equity, it's real estate, it can be private debt, and infrastructure. And they are increasingly becoming an essential component of kind of investment strategies, as David has alluded to. And I suppose, why is that? You think about the level of diversification, so allocating, a greater proportion, because these pension pots, given the size of these pension pots, and we think about the UK as an example, about 20 billion, I think, was invested in 2023 by sort of private equity and venture capital. So, you've got, thousands of companies all looking to raise capital and needing capital to scale and grow. There's not an endless pool of capital where that's coming from. And if you think about those pension funds, particularly around that diversification piece, almost 80 to 90% of companies around the world are privately held. So if we take the US, for example, companies with 100 million turnover or greater, 87% of those are privately held. So if we think about accessing innovation and growth, and to David's point, returns are important, but it's getting that balance. But if we think about returns, innovation, growth, diversification, private markets is just a great way to do that because of the landscape and the sheer, I suppose, scale of private companies in the market.
Why are so many companies being held in private hands for longer? Is that just because they want to retain control of the company?
Yeah, I think so. I think there's probably lots of reasons. I think one is particularly when you think about listing, it comes with the additional scrutiny, the quarterly reporting, and actually being privately held allows you to just focus on growth, not have to report to the market every quarter, and probably affords you a little bit more control around I suppose how you innovate and grow.
David, you wanted to come in and say something?
Yeah, well, I think listeners should just recognise the scale of private markets now. I mean, private markets have grown so extensively over the last decade. They're now about a $13 trillion market. And it used to be the case. People that were familiar with private markets in the past might hear private markets and think these are small companies. These are small sort of venture or early stage businesses. Many businesses in the private markets landscape now are just enormous. They're mid to large cap or even mega cap. I mean, if you think about some of the largest companies on the planet today, many of them are actually private companies. And you've got actually on these two continents, think of this as two continents of capital. You've got the public markets, which are actually shrinking in size. They're shrinking in breadth in terms of the numbers of companies listed. And in terms of capitalization, they're actually getting smaller every year progressively. And most of that attrition is in the sort of mid-cap space. And then meanwhile, private markets are just growing exponentially. And as Chris said, there's now lower incentives to actually list. So I think if you're a pension fund manager and you have a sort of a long-term liability, you can match that with a long-term asset. And they were obviously private markets investments were extremely popular with pension fund managers back when the yield environment was different. But they're still increasingly popular today. I mean, it's not the yield environment that's driving it. It's this idea of, well, if I want to represent the entire possible investable universe for my pension fund members, I have to access this. And particularly if I want particular themes, if I want fast growing businesses, if I want a particular sectoral theme like renewable energy or decarbonization, I just can't necessarily get that clean, pure exposure in public markets. And pension funds by construction have much less demands on them on a kind of monthly basis, intra-quarter basis for liquidity. They can match that long-term liability with a long-term asset much more easier than perhaps the equivalent public market equivalent portfolio manager or fund manager.
Yeah, and I think probably just to go with that, I mean, obviously, private equity, private markets is a long-term liquid asset class. So, as David says, matching that kind of profile for a pension fund is really, really important. I think the other thing to think about is, and David touched on it there, if you think about all the innovation and disruption that's going on around technology or decarbonisation, energy transition, if that's happening in private companies, in private markets, investors are potentially missing out on that growth curve as businesses sort of accelerate. So, if companies are staying private for longer, I think a good example of that, I think, is Uber and Airbnb, for example. I think when they IPO'd, they were 10 and 12 years old. So if you think the growth they had gone through before they'd basically gone onto the listed markets for people to access, you've missed out on all of that growth.
Yeah, and I think it's fair to say private markets are generally not something that retail investors invest in, are they? They are, other than through pension funds. I mean, that is the route to market for most retail investors, because this is really more for professional investors, isn't it?
Yeah,
I think. Well, let me come in. Sorry, Chris. I think that's a fair statement today, Sarah. I just see the trends are changing. So, yes, it's been the case that because of these investments being inherently illiquid and not subject to the same kind of regulations as public markets investments, and particularly in the managed fund space, they're a little bit more esoteric. They've meant that they've only been suitable for more informed investors, but that is changing. That trend is changing. They're becoming more liquid, more accessible, I think, further down the sophistication stack. Sorry, Chris.
Yeah, and I'll just add to that. I think you're right, Sarah. They've always been the sort of preserve of large institutions, or maybe sort of what people see as the ultra high net worth segment. The industry is changing rapidly. Like you say, the technological advancements, and I suppose that drive to access this part of the market for those returns and innovation and growth, does mean there are lots of alternatives now to allow other investors to access private markets, but still typically is accessed by those larger institutions.
I think let me just come in and give a quick one more sort of big picture theme that's happening here. And then we can get under the bonnet a little bit about how this is going to work and the mechanics of it. The big picture theme here is that there is a big demographic challenge for governments all over the world, right? And what I'm saying there is that certainly in the Western world, we've talked about this before on the pod, you have this huge inverted population pyramid that means that there's a big liability for pension provision coming up. And governments all over the Western world, generally speaking, a sweeping generalization, because there are plenty of Scandinavian countries where this is slightly different, but for the vast majority of countries, it's now being outsourced to the private sector, to individuals, to provide a solution for that problem. Okay, so through your self-invested pension, you might make allocations. What this reform tackles is the other side of that, which is still that big pot of sort of public pensions. Now, that's sort of one big trend that's happening. The other trend is that I think governments everywhere across the Western world recognize that they've probably underinvested in infrastructure over the last few decades. And there is a massive amount of money that is going to be required, whether it be decarbonisation or just renewing things like roads and rails and energy infrastructure, that is coming. And America obviously has been very vocal about this with the Infrastructure Investment and Jobs Act that Biden introduced in 21. But my point is that there is probably $1 trillion program there in the US that again is going to be delivered through the private sector, not necessarily the government. And so you've got a lot of trends all converging at once: demography, the provision of individuals' pensions, and then this massive infrastructure bill that we all have to pay, and ultimately the private sector and private companies are going to fulfill the order.
I mean, Chris's number at the beginning about demography was 19 million. By what year was the retired population going to be 19 million, Chris? I can't remember.
So by 2050.
Yeah,
and so
okay.
I think to David's point, all that is, if you look at that inverted pyramid, you're saying, well, the need for well-funded pensions to generate that retirement savings, is incredibly important. And so, by accessing, I suppose there's two benefits here. Investing in high growth private companies, innovation, infrastructure, you're helping hopefully to secure better outcomes for pension savers. But clearly for the government, unlocking hundreds of millions of pounds and investing in growing businesses, helps stimulate growth, the broader economy. So you look at it and think, well, actually, it hopefully benefits, all really.
Yeah, I mean, this obviously taps into this desire by the new government to stimulate growth for the UK economy. Now, we talked about infrastructure spending. If my understanding is correct, is that essentially what the British Growth Partnership is all about, or is it a little bit broader than that?
Yeah, I think it's exactly that, Sarah. It's the government looking and saying, well, hang on, how do we stimulate growth? How do we get investment into these growing businesses that are innovating and driving the economy forwards? And so not just focus necessarily on infrastructure, as David alludes to, though, actually, it is sort of private companies and supporting that. And if you think about some of those trends around decarbonisation, digitization, actually you sort of have this convergence of infrastructure and technology in I suppose a sort of an older format. So I think actually when you think of infrastructure, you might think of bridges and roads, but actually you're thinking now about data centers or supply chains, and actually the use of technology in that to help drive efficiencies and scale and drive growth are just as important as sometimes the infrastructure around them. So actually, I think it's not purely about infrastructure, but actually everything that kind of comes around that to help drive growth.
David, is this public-private partnerships under another name? Or is it private-private partnerships?
The devil's in the detail. It's the extent to which the taxpayer is ultimately on the hook for the risk of the investment. I think in the general sense is no, it's not. This is different. But it's not without its similarities. It's a fair challenge to compare and contrast the two. I think the detail here is important though, because remember, pension funds are traditionally quite conservative beasts. They generally resist exposure to sort of high growth sectors that are perceived as riskier. Okay, so you've got this kind of oversight risk that needs to be worked through. No pension fund is going to allocate 100% of its capital to these kinds of investments. Having said that, in the private markets, there are still these huge companies. There's still private credit that's rated almost high levels than certain public market equivalents. But nonetheless, this won't be the majority of an allocation of these funds, but it will be significant. I think that's the way I'd summarize it. The effectiveness, though, is going to be about the ability to direct capital towards those sort of innovation-driven sectors. So, like Chris is right, it's not just infrastructure; it's technology, life sciences, clean energy, and areas I think in the UK that are often overlooked because we focus so much on the FTSE 100 and the composition of that. We forget that all of those other sectors I just mentioned do exist here. They're generally just not listed.
Yeah. I guess, Chris, I've got a question for you. I know you want to say something, but we don't know yet. I mean, there's been no mandating of the amount of these pension funds that needs to be invested in the UK. So we don't know yet. Do we have any sense of what this means for private markets as far as capital inflows are concerned? Do we have any sort of figures at all?
Well, no, I think hopefully that will become more transparent. I think from a sort of a private markets, private equity perspective, there is, and we don't know, like I say, how much we allocated to the UK particularly, but there is lots of dry powder and investment, chasing private markets at the moment because, if you think about, back to David's point, it's not about necessarily pumping, 50% of the pension fund into private markets, but actually it's about just broadening that diversification of the fund. And as we talked about earlier, just the sheer number of companies that you can access, that diversification changes that risk reward profile of the fund. And so, I would probably, expect that these things take a bit of time to work through. It's likely that somewhere between 1 to 3 years for these sort of funds to get up and running, to establish themselves. That's probably more likely than anything happening in the very near future.
Yeah.
So the number the government have put forward is 80 billion. That's their sort of baseline target, if you like, for deployment into specifically UK infrastructure. I mean, that won't entail the full gamut of investment into private markets, but they're looking at 80 billion for UK infrastructure and projects and businesses. And I think they've come up with that number by looking at the other models I mentioned, particularly Australia and Canada. And Chris is right. I mean, when you look at execution of this, which is obviously now critical, having announced the policy, you then have to get the lawyers to work out the actual wording of the legislation. But the execution varies. If you look at other international examples, it can be anywhere from 1 year to 3 years to actually get this kind of money deployed. You have to doing due diligence in the private markets is a lot more complicated than in the public markets. It takes longer, and it's not as homogenized and standardized as the public markets. So it requires a different skill set.
Yeah. So on the subject of the infrastructure investment, we've sort of kind of drifted into our final point here, but I think that's fine. Is this a paradigm shift away from public spending? Is this completely changing the landscape as far as public investment in major projects is concerned, if this all kind of happens as we think it's going to happen?
Well, I think it is. I think you've got an unprecedented demand for infrastructure expenditure. I don't think I've seen such a demand certainly over my lifetime now. I mean, we're tying together a few threads here, Sarah. Do you remember when we talked about data centers and power consumption, about how there's been no investment in global power generation for pretty much a decade? And I can single power generation out as, I think, the best example, but there's loads of examples across the end-to-end sort of infrastructure network that mean that you've got public deficits growing, this demographic challenge, the need to renew infrastructure that hasn't been invested in for probably half a century. So once you start looking at the numbers, there is no solution, I think, in the public sector to fill that order. You need the private sector to invest in projects, to invest in businesses. Government expenditure, although it's declined as a proportion of GDP progressively over the last 100 years. Okay, we might be in a period now where it expands slightly, but the overarching trend has been getting smaller. Meanwhile, the private sector trend is the opposite. It's been getting bigger and bigger and bigger, and is probably accelerating. So I think it is a paradigm shift, and I think all of these factors converge. The sort of democratization and opening up of private markets, the Mansion House reforms and policy direction that's been announced, demographic challenges, need to invest in infrastructure, the available investment in the universe to managers and specifically pension fund managers. All of these factors combine to mean that I think it is a paradigm shift. I think now we're opening up this side of the market to more investors and more capital than we've probably ever seen.
Would you agree with that, Chris?
Yeah, absolutely. And I did read a stat the other day that projected that the potential global public funding gap for infrastructure is something like 15 trillion. So, and you can only see that really continuing to grow. So I think, I think you're grappling with the funding, and that's, that clearly can't all come from government. So I think, I think private space is going to help support that. And I think, as we touched on before, you're also overlaying the new challenges of, almost redesigning some of this critical infrastructure because of, new technologies, more sustainable solutions. So actually it's not just sort of repurposing old infrastructure. This is kind of new. So I think you need the support. I think it's that partnership of your governments, but the private space too, to really come together and both provide the funding, but also the, I suppose, the capability to redesign some of this infrastructure for the modern world.
Yeah. David, based on, you mentioned a couple of examples of countries where they've done something similar already. How quickly, or when will this happen? How quickly do these mega funds become created? And then how quickly then can they start having an impact?
Yeah, as I said, the international examples, the ones I mentioned, Canada and Australia in particular, anywhere between 1 and 3 years. So, it's about now execution and speed. But then, as I said, there won't be a rush, I think, to you deploy immediately overnight. You have to build programs of investments and understand how that impacts on the pension fund's liquidity and risk profile. It would be incremental, but what we're talking about is this shift that has now started. So 1 to 3 years would be my estimate.
Overall, just a quick takeaway from both of you, do we see this, perhaps come to you, Chris, first, do we see this as a positive development? Obviously, we've got to see, proof of the pudding and all that. These changes have got to happen. They've got to be implemented. And as we've said also, to use another cliche, the devil is in the detail. Do we see this, if it all works out, a positive development for private markets?
Yes, I think absolutely. And like I said, the devil is in the detail. But I think, even David's number there, 80 billion going towards infrastructure, I think actually that will have a positive impact on, the population as a whole around access to infrastructure and what that brings, and the growth that will stimulate in the economy. So I think, I think only a positive.
Just to give people, for those that are interested in the detail, you've got this consolidation process that's going to have to be carefully planned. You've got this transition period, considerations for governance, investment strategies, and then regulatory compliance. All of that stuff has to be worked through. But on the legislative side, the government's going to introduce this pension schemes bill to facilitate the reforms. So the target is to have the consolidated structures in place by March 2026.
Okay.
Then my sort of 1 to 3 year period probably starts. So if you roll the clock forward from today, you're talking sort of 4.5 years probably to have this now then fully up and running and bedded in.
Okay. All right, then. On that note, thank you very much, David. And thank you very much, Chris, for joining us to give us your insights from the sort of private market perspective. It's been really interesting, and it will be fascinating to see how this all plays out. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. As I said, thank you, Chris and David, for joining me today. Until next time on Need to Know, bye for now.